Welcome, everybody, to the February IASB podcast, where we bring you the latest insights from our board meetings. As always, I am joined by my boss, Andreas Barckow, the chair of the IASB, and Linda Mezon-Hutter, the vice chair of the IASB. So welcome, both of you, after a busy and exhausting board week.
Absolutely.
Thanks, Nili.
Hiya.
So in this episode, we will be discussing 4 of our projects. These include 2 ongoing post-implementation reviews, our project on rate-regulated activities, and our second comprehensive review of the IFRS for SME standard. But before we dive into that, we did discuss a few changes to our work plan. So Andreas, can I turn it over to you to share a quick update?
Sure. And before anybody gets freaked out, these are minor changes, to be clear. So the first is on power purchase agreements. As we've discussed in previous podcasts, the board is moving at pace and expects to make decisions on proposed amendments to IFRS 9 in March. We then expect to publish an exposure draft in May, potentially with a shortened comment period, subject to the board's decision and approval from our due process oversight committee. So a slight slippage, but nothing major. Second, we now plan to issue IFRS 19, our standard on subsidiaries without public accountability disclosures, in early May rather than at the end of April as originally expected. And the reason for this is to have extra time to perform our normal quality checks. And relatedly, in July 2024, we plan to publish the exposure draft proposing updates to IFRS 19 for new IFRS accounting standards that were added or amended after February 2021, which was the cutoff date for disclosures considered in developing IFRS 19. And I may also highlight that we've finished our deliberations on the classification and measurement amendments in IFRS 9. We've decided this week that the effective date will be 1 January 2026. So that's about a good 18 months from the expected publication date. And people need to get ready. Some of you may recall a submission to the Interpretations Committee about electronic transfers of cash. This item is also now closed with the finalization of these amendments, and the board will proceed as exposed.
Thanks, Andreas, for the update. So let's move on to our first 2 topics. We'll take them together on post-implementation reviews. As we've spoken in previous podcasts, we have 2 PIRs in process. One is on IFRS 15 on revenue, and the other is on the impairment requirements in IFRS 9. And as we've also mentioned in previous podcasts, just as a reminder that the post-implementation review is the final phase of a standard development process. It's not a standard setting project in itself. It's really just assessing whether the new standard or the major amendments are operating as intended. And as part of the PIR process, the board will decide whether any of the feedback gives rise to sufficiently high priority questions or concerns about the standard that would warrant standard setting. But the PIR itself is not a standard setting project. So with the PIRs, I'll go into some of the details, or I'll ask Linda and Andreas to go into some of the details in a minute. But when the board finishes deliberations, they will publish a project report. And our expectation is that we will have a project report on IFRS 15 and on the impairment requirements in Q3 of this year. So let's start with you, Linda. And if you can give us an update on what we talked about with the PIR of IFRS 15 this month.
Sure, Nili, I'm happy to do that. As we noted last month, the general feedback has been very positive. So stakeholders said that IFRS 15 is doing what it set out to do, and happily, it seems to be doing it well. At the February meeting, we continued our deliberations and discussed 3 topics. Those were identifying performance obligations, principal versus agent considerations, and licensing. Now, many respondents concluded that IFRS 15 offers a clear and sufficient foundation for the accounting in these areas. Yet some respondents expressed mixed views on the clarity of these requirements, along with challenges in application, and particularly in complex contracts and licensing arrangements within the software, technology, and telecommunication industries. The board decided to explore in the next agenda consultation one topic relating to the agent or principal assessment. For all other areas, the board tentatively decided that there really wasn't sufficient evidence to warrant standard setting. But we will discuss later whether to add to the standard itself some explanations from the basis for conclusions on IFRS 15 regarding identifying performance obligations and principal versus agent considerations. So what's next? Well, we're going to have further discussions in the next few months about other application matters raised by stakeholders and whether or not to take action on them. And importantly, because this standard is highly converged with US GAAP, part of our discussions will include a joint meeting with the FASB in June.
Thanks, Linda. Some good stuff to look forward to. So moving on to the PIR on the impairment requirements in IFRS 9, as all of you are aware, the objective of these requirements is to achieve a more timely recognition of credit losses by introducing a forward-looking impairment model that is based on expected rather than incurred credit losses. Andreas, can I turn it over to you to give an update on that discussion?
Of course. We started discussing the feedback we received in November last year. And similar to what Linda has just said about the PIR on IFRS 15, the general feedback on this PIR was largely positive. I'm tempted to say overwhelmingly and unexpectedly positive. No fatal flaws were identified, but some areas for improvement were mentioned. So this month, we deliberated two topics: the general approach to recognition of expected credit losses and determining significant increases in credit risk, which is a new concept that was brought in with IFRS 9. When it comes to recognition of expected credit losses, IFRS 9 requires entities to measure the loss allowance for financial instruments at each reporting date by recognizing at least 12 months expected credit loss or lifetime expected credit losses based on whether the credit risk has increased significantly since initial recognition. Almost all respondents supported this general approach in IFRS 9, although some stakeholders suggested that the board could reconsider the application of the approach, mainly for cost-benefit reasons rather than for substantial fatal flaws, as I said before, for specific types of instruments. And the bits that were mentioned were intragroup financial instruments and purchased financial assets that are not credit impaired. And similarly, on the topic of determining significant increases in credit risk, we noted large support from stakeholders on maintaining the assessment of changes in credit risk as principle-based, but some stakeholders asked for more guidance in complex fact patterns. In light of this feedback, the board tentatively decided that there wasn't sufficient evidence to warrant standard setting in these two areas. And what does that mean going forward? So further discussions in the next few months about the other application matters raised by the stakeholders, such as measuring expected credit losses, credit risk disclosures, and other issues.
Great. Thank you, Andreas. And the board members were also quite profuse in their appreciation for all of our stakeholders and all the feedback that they provided. So thank you to those of you if you've been involved in the process, and we'll look forward to deliberating more of the feedback in future months. So let's shift gears to rate-regulated activities. As many of you may know, the IASB is working on a new accounting standard. I think this will be presumably IFRS 20, that would require companies subject to rate regulation to give investors better information about their financial performance. And this new standard is a supplementary model to IFRS 15 on revenue, and it will replace IFRS 14 regulatory deferral accounts. So, Linda, can you start by providing a little bit of rationale behind this standard and set the scene for us?
I'm happy to do that, Nili. So it's important to note that we're focused on these specialized companies that supply goods or services that are essential to customers. For example, electricity, water, transportation. Many of these companies are subject to rate regulation that determines how much compensation they are entitled to charge customers, and also when they can include that compensation in their regulated rates. Now, differences in timing arise when the compensation for goods or services supplied in one period gets included in the regulated rates charged in a different period. And our project focuses on this specific type of rate regulation that creates differences in timing. When such differences in timing arise, the amount of revenue recognized in the period in accordance with IFRS 15 does not include all of the compensation that an entity is entitled for the goods or services supplied in that period. Or it includes amounts that relate to compensation for goods or services supplied in a different period. Now, our prospective standard aims to provide information to users of financial statements about the effect of such differences in timing on a company's financial position and financial performance. This is achieved by requiring companies to recognize regulatory assets and liabilities and also regulatory income and expenses. Let's try to use an example. So let's say a company incurred expenses of £100 while it was supplying goods in year one, and they have the right to recover it. However, revenue in year one does not include that compensation. A regulatory asset of £100 arising in year one would let users know that the entity has a right to recover the expenses incurred in year one by adding £100 to the regulated rates charged to customers in a future period. Now, we published this exposure draft in early 2021, and the comment period was closed in June of 2021. Now, since that time, we've been redeliberating the feedback from the exposure draft, and we've made significant progress, having covered such areas as scope, total allowed compensation, and recognition and measurement, and others. Now, at this month's board meeting, we discussed how the prospective standard could articulate the guidance on the boundary of a regulatory agreement. We decided that the standard will require that an entity considers both its right to operate and its right to recover a regulatory asset when determining the cash flows that should be included in the measurement of the regulatory asset. We also discussed the consequential amendments to IAS 36, Impairment of Assets, proposed in the exposure draft, and we decided to retain the proposal to exclude regulatory assets from the scope of IAS 36. And finally, we discussed disclosure requirements and made decisions on disclosure requirements proposed in the exposure draft and on some new disclosures that will be included in the prospective standard as a result of feedback we've received. For our next steps, at some future IASB meetings, we'll continue to redeliberating the proposals. The aim is to publish the new IFRS accounting standard in 2025.
Thanks, Linda. And I know that's a lot to work through, but I think it's really important that we start kind of raising the prominence of this project, given that it's the next big new standard that's coming out. And although it's not until 2025 and it's half two of 2025, it is the next new big standard. So wanted to make sure everyone's aware that we're nearing the end of technical deliberations on that one, and we'll start going into the balloting process.
For sure, Nili, we want to get it on their radar screen so they're paying attention.
Absolutely.
And not to forget, Nili, that the next big standard that's coming out, apart from obviously PFS and SWOPR, will be the SME standard, which I think we will be touching next.
Yes, thank you. That's a perfect transition. So moving on to the final project of this podcast and the next big standard after IFRS 18 and IFRS 19, that is the IFRS for SMEs accounting standard. This is our accounting standard for entities without public accountability. Essentially, these are companies that do not list shares in the public market and do not hold assets in a fiduciary capacity for a broad group of outsiders. The accounting standard simplifies full IFRS accounting standards while still requiring useful information to users of those financial statements. So, Andreas, can you give us an update on the key developments of the project this month?
Happy to. So we are making good progress in this final stage of the second comprehensive review of the IFRS for SMEs accounting standard. We published the exposure draft in September 2022. The comment period ended in March 2023, and we have since been looking at the feedback on the exposure draft. In February, we continued our redeliberations and considered feedback on the following three sections of the exposure draft. Section 9 on consolidated and separate financial statements, Section 19, business combinations and goodwill, and Section 23, revenue from contracts with customers. So all big, three big sections, really. If I try to think about the most interesting changes to the requirements in the ED that we've agreed on, I would probably mention the two following. We decided to proceed with the proposals in the exposure draft to align Section 9 on the standard with the acquisition method on accounting and IFRS 3 business combinations. And regarding Section 23, the board decided to change the proposed requirements to make them easier for SMEs to understand and apply. We decided to withdraw the proposals in several areas, including contract modifications, customer options for additional goods or services, and cost to obtain a contract. The next steps will be further deliberations on the proposals from the ED, but we are really nearing completion, and we hope to be publishing the third edition of the standard in the second half of this year.
Thanks, Andreas. So that wraps up all of the projects that we wanted to highlight in this podcast. There were a number of other projects that we discussed this week. It was quite an intense week. And for more detailed information, please do refer to our website. For the next segment, we normally try to cover some questions that have come from our listeners, but unfortunately, I'm really sad that we didn't get any questions this month. So, Andreas and Linda, you are off the hook. The whole goal of these questions is to put both of you in the hot seat. So, listeners, please do send any questions that you might have for our fearless leaders. You can send them to communications with an S at IFRS.org. And that wraps up this month. So thank you for joining us. And if you found this podcast informative, we encourage you to subscribe, share, and rate us on your preferred podcast platform. And we look forward to having you back next month. Until then, take care and thank you for listening.